Hallå allihopa och välkomna tillbaka till Nordnet Talks. Och idag har jag en superintressant gäst med mig och vi tänkte måla lite med de stora penslarna och prata lite makroekonomi och lite politisk risk. Och det ska vi göra med Wei Li. Welcome.
Thanks for having me.
We have to do this in English, I guess, or how's your Swedish?
Or in Chinese.
Or Chinese, absolutely. Tell us a little bit about yourself. What are you working with at BlackRock?
Absolutely. So I am responsible for investment strategy in BlackRock ETF and index investment business here in Europe. And what we do is that we come up with investment themes and trade ideas for clients to consider.
Yes. And sometimes we can see you at Bloomberg and CNBC. And today we have you at Nordnet Talks. It's fantastic.
Very happy to be here.
Very welcome. So just dig into these investment strategies. If we look at world politics, it's upside down. What's happening? It's really hard to predict.
Strange few months.
We had the election in US, UK, and France. For example, there's been several. Of all the risk you have in your portfolio, I would say the political risk is pretty much the hardest to act on. Do you have any advice? Should you act on it, or what should you do?
I think it's a very spot-on observation that it is very hard to manage political risk in your portfolio. But if you look at how markets have reacted after these political events over the last 6 to 12 months or so, one observation is that markets managed to go back up very quickly, even if the outcome of the political events may not be obviously market friendly. So if you think about how quickly UK equity market recovered after the Brexit referendum, if you think about how quickly S&P 500 US equity market recovered after US election, and also how much markets rallied after the French election, it's really remarkable to observe that investors and markets seem to be a bit political election fatigue, and they would rather look through the political uncertainty and focus on the fundamental picture, better growth, better earnings number coming from companies, and use the political events to actually try to take advantage of any markets sell off and build on the longer term portfolio composition that is very much playing to better growth data.
So should you just ignore it as a retail investor?
It's hard to ignore it just because we see so many headlines from newspapers, from TV. But what is important, one comment I would make is that for all this binary kind of election outcome, the impact on the fundamental growth picture is not instantaneous. So if we see markets sell off and growth picture have not responded just yet, you see this very interesting dislocation that could be good to play around and maybe add to your portfolio. But at the end of the day, it's very, very important also to think about diversification in your portfolio. So don't just put all the eggs in one basket. Think about alternative scenarios. If you think Europe is going to do well, don't invest 100% in Europe. Put 5% in emerging markets. Put 10% in the US, just so as the market rotate in terms of which region is leading, you have a bit of exposure in each region.
Yeah. So if you look at, maybe zoom out a little bit from just political risk, but what are the key risk scenarios that the investor should look at for next year, or at least 2017, or what are you using?
Indeed. So if you look around, what could potentially shake up markets? If you look at,
everyone is waiting for it. You know,
everyone is.
The Swedish stock market has been so strong for like 8 years now. So everyone is looking for, when is the big bang going to happen here?
Well, let me ask you one question then. Over the last 8 years, what has been the consistently supportive factor to markets?
Now, we have lower rates.
Exactly, you are spot on.
Yeah.
Lower rates, supportive central bank. That has
Yeah.
been a very, very strong driver in terms of positive sentiment for
Yes.
markets. And now that is starting to change. And that is what worries us quite a lot. If you think about the US central bank, the Federal Reserve, they have been hiking rates. Even as data started to go sideways, they continue to hike rates. They stopped QE, quantitative easing, which is basically pumping money into the markets and pushing prices higher. So as they stop QE, as they start hiking rates, the impact on markets can be very, very profound. So one way to approach it is not to avoid market altogether, but to try to understand what is the implication of the Federal Reserve hiking rates. What does it mean for the dollar? What does that mean for regional preferences? And try to be a bit selective in where you own your exposure that would play to this new regime that we're entering.
It's so hard. I think a lot of the retail investors, like private persons, most of our money are saved for our pension. That's the biggest part is. And how should you look at this? Should you, I mean, sometimes you feel like the equity market is too high or too high value, but on the other side, the interest rate can only go up. So you really don't want to put your money into the fixed income space. So what should you do?
Yeah, pension investors and for that matter insurance investors, they face similar challenges, which is the need for income. And for a long time, government bond yields were at a level that satisfy that income need, but no longer do they satisfy that income need, which is why we see investors, and we think that makes sense, to go into the equity market for additional income, maybe overlay that with a dividend strategy, picking up exposures within equities that give you additional dividend payout and really deliver you income pickup that government bond yields no longer give you. And you talked about valuation being stretched in equities. If you look at cross-asset valuation, valuation looks quite a bit more stretched in fixed income in comparison with equities. And within equity space, US is a bit more stretched in comparison with Europe, so you can be a bit selective and try to still pick up a bit of value.
So then we come into this. Where should you? Where is the largest opportunities when it comes right now? Where should you look? Which areas should you invest in?
Indeed, we like European equities at this moment. We have seen earnings coming through. So over the last 2 quarters, for the first time in over 7 years, European corporates exited earnings recession, where they saw earnings going down. No longer, it's starting to come back up in response to better growth data, in response to global trade volume picking up, and that has been very, very supportive. No longer making the valuation stretched for European companies. And at the same time, we have seen a lot of investors allocating into Europe that really help push up the momentum of the price movement. And lastly, we talked about a bit of political risks. After Brexit, after US election, people are worried about Europe going into 2017, thinking this is a year full of elections. You know, would there be domino effect from all this anti-establishment outcome? We have actually seen the opposite of that. We're starting to see this axis between France and Germany strengthening. We're starting to see reform momentum and expectation picking up, and that has had a very profound impact in terms of making sentiment better towards Europe. And everything added together, we actually favor European equities.
Okay. Are we underestimated the power in the comeback of the economy? Because we've been talking a lot about like Tina, there is no alternative, so that's why we'll go into equity market. But actually, if you look, as you say, if you look at the European companies, they're actually going better and better. We'll see this. We have a Q2 season coming up here in July. Do you think we underestimate that? That is perhaps actually we're going into a time where the economy will pick up again?
Well, we actually have the view that growth will deliver and materialize not only in developed market but also in emerging market. So in BlackRock we have in-house indicator for growth, not only looking at what data is publicly available out there, but we use big data capability to try to understand where sentiment is heading towards, what people are saying in social media, what they are tweeting about, what they are talking about on Facebook, what are they searching for on Google, and trying to really have this real-time impulse of where things are going, and based on our own indicator, it's actually registering greater growth expectation versus consensus. So we are actually of the view that growth would come through, and the way to play that would be through regions that are actually benefiting from better growth globally, such as Europe, such as Japan, and such as emerging markets.
So if we look 1 to 5 years from now, which asset class and region do you prefer?
Okay, 1 to 5 years, I would talk about emerging markets actually, because from a long-term strategic investing perspective, it makes sense to search for value. And right now, if you look around, emerging market assets, both in the case of equities and fixed income, they offer you very attractive value. And in emerging markets, the economies are going through very meaningful changes. In China, for example, the economy is going from investment-led to consumption-led, and that means better growth quality, and that means greater international adoption of the underlying market. So all of that are positive drivers that could really get investors to embrace this exposure that is not very loved or hasn't been very loved for a very long time. So we do expect over a long period of time value investing to favor emerging market equities and emerging market debt.
Interesting. You know, Sweden is a very small country, and we're very dependent on our export. A lot of companies are exporting companies. Of course, as a Swede, you're quite worried about the more protectionistic view of in US, for example. What do you think will be the outcome of that? Is it just talks, or will there be a trade war, or what do you think will happen there?
We were worried as well immediately after the US election, which is why if you look at Mexican peso and Mexican equity market is sold off significantly, but it's recovered. And you know why? Because the risk of global trade war has been overblown. We have had a group of researchers going to Washington, speaking to local companies, speaking to policymakers and lawmakers, and the conclusion that they brought back is that it's incredibly difficult to get things done in the new administration in Congress. And as a result of that, the risk of that external trade war probability has decreased, and which is why we are rather comfortable about owning emerging market assets at this point, because we think that they are less vulnerable to this prospect, and equally from your perspective as well, I would imagine.
So, one last question is, you always look after these black swans who might show up. If you look at Europe, where do you see next problem, or could be a problem for Europe? Because if as you say, it looks better and better. You know, politics going the right direction. The companies are going better and better. Do you see anything that worries? Indeed, cloud on the sky?
I would actually go back to central bank movement again. We're talking about the European Central Bank right now, staying very accommodative, very supportive of sentiment. But historically, the divergence between the ECB, the European Central Bank, and the Fed, the Federal Reserve, they don't last for very long. So if the European Central Bank is forced to normalize policy, to stop being supportive of the underlying market, then we could have a situation where risk assets have a bit of a knee-jerk reaction and give back some of the gains. And in the long term, Europe has structural problems, aging demographics, low productivity, as well as a very high debt to GDP level. So if we don't have the momentum of supportive central bank and growth growing the economy out of trouble, if that momentum stops a little bit, we could easily see risk assets coming under a bit of pressure. So definitely something to watch out for.
Okay. Thank you very much, Bailey, and good luck.
Thanks for having me.